see those massive headlines all the time, right? Some tech giant buys a smaller company for billions of dollars. But have you ever stopped to think about what happens the day after the deal closes? I mean, behind the scenes, accountants face this giant puzzle. How in the world do you take two completely separate companies and merge them into one single financial story? Well, it turns out there's a very specific playbook for that.
And it sounds like a simple question, doesn't it? But think about it. It's not like just adding two numbers together. You're combining everything: buildings, patents, brand names, customer lists, and yeah, all their debts too. So how do accountants take that complex mess and turn it into a financial statement that actually makes sense? Well, there is an official set of rules for exactly this situation.
And that's the playbook we're going to get into today. Because, without a common set of rules, every company could report a big acquisition any way they wanted. It would be total chaos, and you'd never be able to compare them. So to prevent that, there's one global standard that pretty much everyone has to follow. That rulebook is called IFRS 3, that's International Financial Reporting Standard 3. And its whole reason for existing is to make the information about these huge deals relevant, reliable, and maybe most importantly, comparable. It's all about making sure that when you're looking at the numbers, you're getting a consistent and, a transparent story. Now, right at the heart of IFRS 3 is a process called the acquisition method. The best way to think about this is as the official, step-by-step game plan that accountants have to follow. There's no winging it. This is how they make sense of the entire transaction from start to finish. So we can actually break this whole thing down into 3 key stages, which makes it a lot easier to understand. First, you set the stage. Figure out who's buying who and when. Second, you have to value everything that's being bought. And third, you calculate the premium that was paid over that value. We're going to walk through each one. Okay, to make this a little more real, let's use an example. Let's say a huge tech company, Megacorp, is buying an innovative startup called Spark Inc. So stage 1 is pretty simple. We just identify Megacorp as the acquirer. They're the one gaining control. And we pinpoint the acquisition date. That's the exact day control officially transfers. See? Easy enough so far. But now we get to stage 2. And this is where the real heavy lifting happens. With the date set, the accountants now have this enormous task in front of them, figuring out what Spark Inc. is really worth, piece by piece. And that means putting a price tag on every single asset and every single liability. And to do that, they use a crucial concept called fair value. Now, the key thing to get here is that fair value is all about the present. It has nothing to do with what Spark Inc. paid for its headquarters 10 years ago. Nope, it's about the price they'd get if they sold that building today. The whole process is anchored in the reality of the market, right now. And this brings us to what's called the measurement principle in the standard. It means Megacorp has to go through Spark Inc.'s entire list of assets and liabilities, all its cash, equipment, technology, and all its debt, and remeasure all of it at today's fair value. It's basically a complete financial reset for Spark Inc. on the day of the deal. And this is where it gets really interesting, I think. A lot of the time, a company's most valuable assets aren't even on its own books. Think about Spark Inc.'s brand name, or its list of loyal customers, or some amazing technology it developed in-house. Before the deal, those things might not have had an official dollar value. But now, Megacorp has to identify them, figure out their fair value, and put them on the balance sheet for the very first time. Okay, so once every single thing has been identified and valued, we finally get to the last big calculation. This is where we figure out one of the most famous and probably one of the most misunderstood ideas in all of business: goodwill. The official definition here sounds a little academic, I know, but the idea behind it is actually pretty powerful. Goodwill is basically the value of everything else that Megacorp bought that couldn't be individually identified and priced. Think of it as the price they paid for future potential, for things like the great synergies they expect, or the value of having a brilliant assembled workforce ready to go on day one. So, how do we actually calculate it? It's surprisingly simple. On one side of the equation, you have the total price Megacorp paid for Spark Inc. On the other side, you have the total fair value of Spark Inc.'s net assets. That's all those assets minus the liabilities we just calculated. The difference between those two numbers, that's goodwill. Let's use our numbers to make this crystal clear. Let's say the total price, the consideration transferred, that Megacorp paid to buy Spark Inc. was $500 million. That's the cash, stock, the whole shebang. Now remember stage 2? After Megacorp's accountants went through everything and revalued all the tangible and intangible assets, they came up with a number. They determined that the fair value of Spark Inc.'s net identifiable assets was $350 million. And there it is. The math is as simple as it looks. Megacorp paid $500 million for a company with identifiable assets worth $350 million. That extra $150 million they paid, that premium, is recorded on Megacorp's balance sheet as an intangible asset called goodwill. Now, just as a quick aside, you might be wondering, what if they paid less than the assets were worth? Say only $300 million. It's really rare, but it's called a bargain purchase. Maybe it was a forced sale or something. In that case, Megacorp would actually get to record an immediate $50 million gain. Pretty cool, huh? So after going through all of that, you got to ask the big question, why? Why go through this incredibly detailed, complicated process? Why does this rulebook even matter in the real world? Well, the standard itself tells us exactly why it exists. The whole point is to improve the relevance, the reliability, and the comparability of financial information. It's about making sure the story of the merger is useful, trustworthy, and consistent for everyone. And that's really the bottom line. Whether you're an investor trying to make a smart decision, an analyst, or really just anyone who's interested, these rules make sure the story of an acquisition is told the same way every time. It's what builds trust in the market and lets us make fair apples-to-apples comparisons. But of course, you have to remember, IFRS 3 is really just the playbook for day one, the accounting part. The real test for Megacorp starts on day two, actually turning that $150 million of goodwill, that premium they paid for pure potential, into real tangible value. And that leaves us with a pretty big question. Of all the companies that make these massive bets, how many of them actually succeed?